Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, July 6, 2023. It's 11:31 a.m. Eastern Time as I'm starting the video. I am back in my office as of last night. Of course, I got that post out to you late, coming off a 15-hour drive back from North Carolina. As I said, been on vacation over the last week and didn't see really anything in the markets. I spent a lot of time with the family, jumping to a couple locations and really stayed off the computer because there was nothing new to report. But I do want to update something I've been highlighting recently, and I need to clarify, and this bears repeating. One of the long-term indicators I was watching, or a couple of them actually, last month. This is the monthly chart of SPY, the S&P 500 tracking ETF, and one of the more reliable trend indicators. So that did close the month positive. Week of 4th of July is one of the lowest volume trading days of the year. Just about everybody's on vacation that week, and so you tend to see. Usually, it's from my experience has been. I think I didn't know the stats. You can look it up, but it's usually an up week, and we closed the week up. And so what that did is it finalized that candle. I'm talking about the, again, monthly chart of SPY right here, the S&P 500 ETF. So we printed a solid close above there. And that in itself flipped that trend indicator. I'm talking about these, the yellow and blue lines right here. Let me try to change that tool color. Right here, they intersect the 20-month exponential and simple moving averages. The yellow is the simple, the blue is the exponential. It responds a little faster to prices. And so we got that. And however, what we didn't get is the PPO crossover on a closing monthly basis. Remember, we're just in the first few trading days of July with the holidays and all that, and so this one we will not have a final close or a final a print until the end of July now. So I'll take it for what it's worth, but I've made this very clear before. This is a long-term trend indicator, not a timing indicator for active trading, for swing trading, short-term trading. It is a long-term trend indicator, and it's one that, again, has had a pretty reliable track record. With that being said, because there were several comments before I left, hey, Randy, are you going to flip to bullish and go all long after that? I said, absolutely not. It helps to formulate the longer-term view. I will always position off the primarily, especially on I'm talking swing trading now. I'm not talking 401k monies and all that stuff. I will always position swing trading off the intraday charts, and this just helps to formulate that bias. And so right now, it certainly calls the bear market scenario into question. But until and unless we take out the old highs from the beginning of 2022, very much you can still make a case for a bear market. It can come in many ways. So wanted to say that we're still in relative proximity of the long-term fibs and all that, Fibonacci retracement levels. So I will acknowledge that, but also it's kind of a mixed bag. You didn't get that confirming signal there. And what I wanted to just show you here and why it's not a all or none binary, black and white, you're either short or long above that level. Yes, 401k monies, absolutely. You can use that indicator. You can move your 401k if that's your thing, move some money into equities, and then just respect a solid close back below it. Because as I said in the post today that I got out to you on Apple, I still expect, on Apple, a 30 to 50% drop from roughly these levels. We don't have the sell signal yet. I'm going to get to Apple in 1 second. But if we cross back down below, and what I wanted to show you is what I was referring to in today's post, should this prove to be a whipsaw. Number one, it is one of many indicators. Like I said, last month we had one flip to a buy, and this one right here, the PPO histogram remains on a sell. And what if you're new to this, if you're just catching up, it's when the PPO, which is the blue and white line here, when the PPO line crosses a signal line, the white line or the 90 EMA is your signal line, blue line is your PPO, then you have a bullish crossover, and it's a great trend indicator. So if you follow it up there, all that was green, and it said be long and strong. Actually, I'm sorry, I went a little farther there. And you can see right here, it crossed over gave you a sell signal, captured all of that downtrend, and then flipped back, said get out of those shorts. It's now a bull trend, and you can see. So even the seemingly small drops, most of those were double digits or close to 20%. They were all over 10% drops. And then in recent years, we've had these, breakdowns, and then the Fed stepped in with, every time that the market squealed. That was back in 2018. They tried to started a rate hiking cycle there. The market said, nope, we will not have it. Through a tissy fit, as predicted at the time, the Fed pulled a 180 and gave the screaming baby what it wanted, meaning it took, instead of continuance hikes, it went the other way, stopped hiking rates, and then of course we know when COVID hit, it pulled them down to zero. So now what I wanted to show you is whipsaws. Let's talk about that, and you'll see. And again, this is not a whipsaw unless it fails. A whipsaw is if we close going forward, whether it's July, August, September, October, if you see a monthly close back below, and you can see both the 20-month exponential and simple are right there. From where we're at today, we're talking still about 5% below current levels. So really anything much below that, then you have a whipsaw. What is a whipsaw? A whipsaw is when you get a signal, and then that signal proves to be very fleeting and is immediately or very shortly after reversed. Now, on a monthly chart, that can't be reversed until July 31st or whatever. I didn't look what day of the week that is, whatever the last trading day in July is. There was a close below them. That was a solid sell signal. I believe by every metric, technical and fundamental, that would have been a much larger, longer bear market, but the Fed wouldn't allow it. You have unlimited money printing powers and, power with the federal government and all the central banks around the world and governments to stimulate. So they foiled, and that proved to be a whipsaw. So whether, whatever the reason is, it doesn't matter technically. I'm speaking technically here. We closed right back on there the following month when COVID hit, and then you had a solid close back above. So that was a whipsaw. Back in 2018, when the market threw that hissy fit, you had a solid sell signal. But again, the Fed pulled a 180 pivot and the following month. So these are whipsaws, guys. And I still, me, I'll tell you if I change my opinion, I have no qualms or problems of being wrong. I'm wrong all the time. I'll tell you that's the only guarantee I'll ever give you is I'm going to be wrong, and I'll be wrong a lot. So right now, I still think this will likely prove to be a whipsaw. But as far as, let's say, again, swing trading, we're trading off, or I am, the 5, 15, 20, 60-minute charts, daily charts, things like that. Long-term trading, wouldn't be, if you have, let's say, your longs in your 401k, no reason to pull them out now. You could certainly, if you want to increase that long exposure, do so. And then if you see a clear failure, then you could pull that money back out, put it in cash or whatever you want to do. So again, just go back in time. You can see whipsaws are not uncommon. Again, I've said it many times, there's not any one perfect indicator. If there was, we wouldn't be having a discussion right now. Everybody would be using it and everybody would be uber rich, right? So just keep that in mind, that this indicator is very reliable. If you just eyeball it and look at being long when you're above, when the market's above the 20-month moving averages, you're long. And when it crosses below and gives you a solid signal, that's a sell signal. I know of very few more accurate and simple indicators. It's that easy. There's not a lot of moving parts to this one. So, all right, enough said on that. So there it is. From a long-term perspective, it does start to call in the, bring to question whether this is a bear market rally or not, but it certainly does not eliminate. Again, technically it can't be eliminated until you've taken out the previous highs. And that point, you can say, well, that wasn't the start of a bear market. Maybe you go make a marginal new high and then do this. And then that technically is the start of the bear market. And again, I'm talking semantics here, whether that was a bear market. You can call that bear market if you want. You can call it whatever you want. You can call it a correction in a longer term ongoing bull market, or you can call it a bear market. All right, enough on that. Let's just jump down to the shorter term charts and move on. I'm going to cover the indexes briefly. I got some updates out to you last night. Like I said, as soon as I got back, we'll hit on the FANGs. And then I had a request for updates on natural gas and wheat today. I'll get to that. I haven't had time to go through the questions since before I left town. There's 50-something comments in that last post I made the day before I left. So I'll go over some of the trade ideas that I highlighted throughout to you recently, and that will be BYND, CVNA, HOG, HA, KF, and a couple others I had price alerts on in the last couple days. Okay, let's dive into it. 60-minute charts. We'll start out with QQQ. So what happened since I left? The Qs haven't even, they actually fell on the QQQ slightly above the previous high. So that's effectively, you can see that little squiggly line. That means roughly, for all intents and purposes, that's another divergent high. That's almost an equal high. Again, you don't want to look at, split a few pennies, fraction of 1%. So you had negative divergence there. This is your divergence. So I know, and again, I've seen the comments before I left, and I could see the market drifted up while I was gone the week of 4th of July, but it's gone nowhere since the last few weeks right here. This is on the S&P 500. That's why I looked at, that's a broad market. And it's probably a little wider in QQQ because QQQ, yeah. So it's less than a 4% range on QQQ and a 3% trading range over the last nearly month now, over 3 weeks in SPY. So the market's gone nowhere. So we all have our opinions. I've seen it. The dip buyers will buy the dip, don't fight it. We're in a bull market. Blah, blah. Nobody's right or wrong in the last 3 weeks. We've gone absolutely nowhere on both QQQ and SPY on the last 3 to 4 weeks. We're right about where we started. So it's just this little kind of consolidation, and we'll see which way it goes. Which way I think it's going to go. And again, we never even took out that high in QQQ. And I gave you this chart before, since we broke this wedge right there, that small 60-minute rising wedge. I've been targeting it minimum a pullback to this uptrend line. That's the uptrend line off the mid-March lows, and I'm still targeting that at minimum. And then if that breaks, that is to me, a very significant trend line that's going to lead to a more powerful sell signal. I believe it will break. And this is if it breaks, this is my preferred swing target down here, about 321.50. From where we're at right now, if that target is hit, that's going to be about a 12% drop in QQQ. And as I said this morning, and I've been saying for weeks now, any marginal new high will still be a divergent high. That doesn't guarantee a drop. I've been doing this a long time. And the day I changed my strategy, these divergent highs and lows are one of, but not the only, but a big part of my trading. And so I look for divergences coupled with overbought conditions, coupled with support and resistance level breaks, whether it's positive or bullish divergence. Again, not to beat a dead horse, but that was why the FANGs were my favorite top weighted. I listed Apple, Tesla, and what was it? One of the other big, Amazon is my 3 top picks, overweighting the Qs. Right here in the beginning in January, that's where it was at the breakout here. That's QQQ as my top picks, and we went long there. At least I did, and I know some of you did. And again, admittedly got out early, but it was those same divergences, and they really were coming off on the daily time frame. We had the divergence on the 60. We were coming off this big divergent low back in mid-October, and that was so far the bottom. And just like we had, the divergent high here. So that's it from a bigger perspective. Divergent high, we swung it down there, highlighted and covered those shorts, went long on the divergent low, came that bounce. So that's what swing trading is all about, is a big part of it for me, is just trying to capture these trends. Divergent low, divergent high, you have trend line breaks along the way. Again, it's those support level breaks. When you're rallying, the objective time to take profits on longs and or to short to try to call a turn in that rally is a rally into resistance. So we had back here, I had a bounce target zone, which was a confluence of the 200-day moving averages and the primary downtrend line. That was a 24% bounce in the Qs. We reversed it there, swung it down there, and again, you can see, and that's where we're at now. Divergent high on the indexes. I don't have my indicators turned on here. I need to do that for you. Hold on one second. Okay, there you go. All right, let's just jump to the futures real quick. All right, let's go to NQ. That's not NQ, that's NG. Let's go to NQ. That's the most recent rising wedge. Remember, we had this on this 60-minute time frame we're looking at here. We had a a bearish rising wedge pattern. We put in a divergent high. That's your divergence down here with indicators making lower highs and prices making higher highs. There's your divergence line that forms the top of the wedge. A sell signal. Reverse a little shy of my target. At the time I highlighted an ES and NQ. We had positive divergence. We had a little downtrend line. Stated that was one of the last updates I gave you. Yeah, it was right here on June 27th. That was, the day before I left for vacation. And told you we had divergences building on ES, positive bullish divergences, and a break above the trend line would likely spark a counter trend rally. It carried a little bit higher than I thought, but again, let's look at what it did and where we're at since then. We have ES. Let me start there, and then I'll jump back to NQ. NQ is my preferred trading proxy most of the time. Sometimes I'll prefer ES over, depending on what's going on, and I'm going to get to the financials in just a second here in this video. So that was it. That was our last divergent high right there. Divergent high. There was a break, and there's that downtrend line that I pointed out the day before I left for vacation. Saying a break of that would likely cause a counter trend rally. Carried a little higher than I thought, exceeded the fibs, but what it did, and please hear my voice when I say this, the charts are dynamic. That means they're changing. They change on a daily basis. Right before I left town in the video, I said, look, if it breaks this level, I wouldn't be adding. And see, it would have been that point you could add here. Now we carried up. So we broke that support. Remember, 44, 41, 80. So 44, 42, we'll call it. And it popped, and we cleared it. It broke resistance. And so we had a nice rally. So you wouldn't have wanted to short that breakout. You would have wanted to hold off. However, that's why I got the post out to you last night. That was over a week ago. So we came full circle since then. What we did at that point, we went in to put a very ever so slightly marginal, a little bit higher high, but the divergence that was in place before I left town only got bigger. And so that, again, sets the stage for an even larger drop. So we had a little divergence, a little wedge there, right? That played out for a rally. And then we set up, again, you can see here, this is a chart I got out to you last night. We have a uptrend line right there and the divergence. And as I said before, should we reverse today or sometime this week and make a marginal high, these indicators are severely lagging now. So any new high will most likely be an extension. I wouldn't bank on that happening, but I will tell you that it's not going to change my outlook much unless we blast on through there and then we move up and these indicators come up here. And then we don't have the divergence on the 60s anymore. Then it makes a really, you can't make a case, really, a strong bearish case, at least me, my trading style. This is a big part of, everybody uses different indicators and different things. So that's ES. NQ, here we go. All right, so this is that 15-minute chart. I wanted to get both out to you last night. I know it may be a little redundant, but it just kind of, it's zooming in. It's like, you're taking, it's like looking under a microscope or a telescope. I give you the 60-minute chart, which showed this from a bigger perspective, and then this little 15. So if you were, I got out late. I got home so late. It was about midnight on the East Coast, but there's West Coasters out in California, wherever. Trading in Hawaii, you have plenty of time, and you can trade this at night, or of course the folks on the other side of the pond. But there is your breakout right there, breakdown. I'm sorry. So we broke down shortly after I posted it. We took out both that 313 support, and then you can see how it works. Support once broken becomes resistance. You had multiple additional opportunities to add to or initiate a short on NQ. And once the buyers failed to bring that back up and make that a false breakdown, the bottom fell out. Not the bottom fell out, but that was a strong drop. That was that was a 1.5%, almost 1.5% drop there, better than a 1% drop. And here we are. And these are the levels I gave you. So this is the way active trading works. You short here. If you want active trade, that's one of the best near-term, short-term support levels. Why is it? Well, reaction from above, reaction from below. Once support's broken, it becomes resistance. Yeah, I traded through it a few times there, but again, another reactions, and another reaction. So the way this works is if we bounce that level, even though we went through it, still had quite a few reactions. It was support. and it becomes resistance. That's an objective shorting up, as would be that. Anything much more, the back test would be painful to ride out, but you could certainly, if we get up there, because it's still going to extend that divergent high. So that would be an objective short. And I speak to all these entry points because everybody's different. I imagine a good percentage of you that are listening to my voice weren't awake at midnight last night when that post went out, able to jump on this. Again, if you're on the East Coast. So that's how that works. And I still, going about to the longer term, that's just a 15-minute chart. Active traders can gain little reactions off those levels if you're so inclined. And then this is the same chart I gave you, but on a longer term time frame, 60-minute charts, the same trend line I've been targeting since back here. And there was that wedge break, went down. And then we just have another bearish rising wedge. There was a breakdown. And right now on the 60, which is this is my preferred swing trading time frame. When I say that, what I mean is sometimes I'm in active trading mode and I'll game the 5-minute charts, 15-minute charts. But this one, for most swing traders out there that don't try to game all the little micro squiggles, by that I mean, 0.5% bounces and 1.5% moves between all the little what I call micro levels on the 5-minute charts, 15-minute charts. This is a go-to, kind of the gold standard for me for swing trading. And so you took out the trend line and support, and the most likely scenario now is whether we bounce back or not, we're going to probably move down and hit that target. Now, again, if we do bounce higher, you can see here these indicators are lagging. All that's going to do is give us a potentially a larger divergent high, would clear out the old, take out the old highs. And again, if that happens, we'll see how the charts develop, if there's any trend lines and if there's any objective shorting ups. Now, I'm just based on the technicals. I am not flipping to a longer term swing or trend trading bullish bias now. I will continue to provide my analysis. That is key support levels, resistance levels, developments. I'll give you other trade ideas, which I'm about to get to in a second. So even if you are bullish, and I know a lot of you, I see the chatter out there, a lot of you, just buy the dips. Well, here are all your support levels. You go down to the QQQ, 5-minute chart. I have that marked up. I gave you a post. I put this chart out there today for active traders, showing you what I call the micro levels. 369. You have a gap up here, but that's also resistance. 366.15 right there. You got a nice thin zone where I'm taking it across from this price histogram. So, what I mean by microanalysis, see, we took it out. Support once broken becomes resistance. We've been rejected once, twice so far. So this is what I would expect to happen. So you can, as a micro, again, active trader, you short there with a relatively tight stop above. 0.63% might not sound like much, but if you trade NQ, I don't have to tell you this, just a handful of contracts or even one contract to NQ. Or if you don't trade that, the MNQs is going to put, thousands of dollars in your pocket on the NQs if you get that move. Again, depending on how much. It's all relative to what you have. You're not going to make $1,000 on a 0.6% move if you have a $10,000 account. Again, I'm talking relative, but it's worth it. In my opinion, wash, rinse, repeat. You get enough of those, and at the end of the day, you made a few bucks. And then 362. This one's kind of meh. Like, I'm not crazy about that level, but I'm leaving it there. That's a better support level where I'd expect more higher odds for a reaction. But again, it's all, like I say, everything is dynamic. So if and when we get there, then I can, assess the charts at the time to see how likely a bounce is. So at this point in time, I can just tell you these are the likely points for reaction if and when we get there. Likewise, if we were to bounce and take out 366, we want to go on and start backfilling the gap. I know a lot of eyes will be on a gap backfill, but I suspect we'd get a reaction at that 369 should we bounce. I favor this, and as you guys know, I think unless there's anyone new to the site since I've been gone, this is the big one for me right here, Apple. And so what I've done recently in recent weeks for you is go over the big fangs. This is QQQ, but as I always say, an index is simply a sum of its parts. The NASDAQ 100 has 100 parts or 100 companies in there. However, about 95 over, The bottom 90 something percent of the, or 90 something companies, almost 90% of it, doesn't even matter, doesn't even move the needle. It's these top handfuls, the top 10, and really about the top 6 or 7 make up, as you can see here, somewhere I have it. Let's see, right here, as of June 5th, 1, 2, 3, 4, 5, 6. The top 6 companies made up over 50% of the NASDAQ 100. So that's why we don't have to look at all 100. We just have to look at these. There's Apple. This is the best looking setup I've seen since the bear market started, or any of these bear market rallies, all of which we caught. And again, you got to wait for the sell signal. And that's why it's not an all-in moment in the NASDAQ 100. That's why we can still go on to make a marginal high or not. But I can tell you the odds are going to go up substantially if and when we get a solid break below that uptrend line, just like we did here, just like we did here, just like we did here, and so forth and so on. And that's a very long in the tooth one. And it's these divergences, guys, just so you know. It's these divergences and everything else that tell me it'll probably be more than just a quick 3% buy the dip opportunity like it's been for so long now. So again, we need to get that solid. What does that mean? Well, as I like to say, the redder the better. So, if you break the trend line intraday, you start moving down. That's one thing. That's certainly a sell signal. You get a solid close below. That's even better. And the farther you get away from it, the more likely that breakdown is, the more likely it is to stick and not prove to be a whipsaw. So there's Apple. Right now, all eyes are on Apple, all the buzz. Like I said, I was on vacation, and I gave you that chart today. Pretty clean stuff. You can verify those numbers. Let me know if I'm wrong. Just check this out. So, that's when the headlines. What was the first $1 trillion company right there in the U.S., publicly traded company? If you bought that, you lost a third of your money. Then it became the first $2 trillion company here. A couple days later, it topped. And if you bought that headline, because they bring out the cheerleading squad on, CNBC every time it does this, tell you the stock is invincible. They got stock buybacks going. And so, over long term, this is investing. This is not, but this is swing trading. And if you can get out of your longs before these corrections come, and especially if you can turn around, from being long and go short, as strong as this chart looks, your returns are infinitely higher than what you see here. So that right there, kiss of death when it crossed the $3 trillion mark. A year later, if you bought that headline, you would have lost a third of your money. About $1 trillion of that $3 trillion market cap was wiped out. We're back to where we started. And again, that was the headline I saw the other day. As I said, one of my in-laws, TV's on all the time on CNBC. And that's all they were talking about all day. And so, we'll see. This is where, based on long term. But I put a caveat in there, and that's what it is. Take it for what it's worth. It's a little asterisk. We need to see that Apple's not going to go down and lose a third or half of its value if we're not in a bear market with another big leg down to come. That I can all but guarantee you. So we're going to need to see those monthly indicators flip back down, and we'll need to see the market take another leg lower for Apple to come all the way down here. Otherwise, it's still a swing trade. It's just not going to drop 30 or 50%. And where to? Again, I think I might have targets on another board. Then the other ones, Microsoft, as I said, the best trend line I could come up with. It wasn't crazy about it. We're below trend there, so you had a check mark there. So the way I do this, again, this is what I was doing before I left town. I have these little boxes on each one, and I give it a, check mark or an X. So far, it's an X on Apple. Imagine that's red, not green. So no sell signal yet on Apple. And Apple being now the largest and top weighted, that we need to see this one break, or the Qs are only going to go so far down without it. Microsoft, we got a check mark there already last week before I left. Told you that. Alphabet, we had a check mark there. I told you I wanted to see a break of this support zone right there. We got that. We went down, and I think I said this last week, and if I didn't, I'll say it again. This back test, Remember, support once broken becomes resistance. There was an objective short entry on Alphabet. But again, do you go heavy on an Alphabet short? No, not until Apple breaks. Because if Apple were somehow able to continue higher, say above trend, then this will probably prove to be the whipsaw, and these indicators will turn up. You can see the PPO is testing that zero line. So again, either if you want to not try to get ahead of it, and you want to be that second mouse that gets the cheese, hold off until Apple and Microsoft Meta. But we do have, again, this is just another check mark for the bearish case. But as I said, the more these fangs break down, the better, and especially the largest one. Apple is both by cap weighted the largest, and it's a big psychological. It's probably the most popular stock out there with both individual investors and retail investors. And, all right, so Amazon, as I told you, broke the minor trend line last week and is back tested. So it's still technically, in my book, on a sell signal. It's just not going anywhere because it's waiting on Apple and everything else. Remember, these stocks are heavily indexed, and they're only going to go so far. They move more so on their own fundamentals than the ebbs and flows into the market. Money coming in, money coming out of the indexes, S&P 500 and QQQ. So it is broken down, and the minimum target is that uptrend line, that secondary uptrend line right here. I know this is a busy chart. So that's it. So there's a check mark because it's not a false breakdown. The breakdown is still very much intact below, again, this minor uptrend line. NVIDIA, as I said, has a lot of work to do because to give a sell signal, it needs to break that 375 level. I covered that last week. I suspect it will, but unless it does, it can easily go on, make a marginal new high. See these divergences, they would only be extended. So again, you may not like what I'm saying, but my view, my longer term outlook isn't going to change. But again, or at least intermediate. Let me make that clear. My intermediate term outlook, unless we start burning through these divergences right now. So we could turn down, and it's simple. This is where I become more bearish, more short when NVIDIA breaks that level, likely going to backfill that gap. And of course, Apple needs to trigger sell signal. Tesla, as I said, I gave a check mark before I left town on this breakdown right here. There's breakdown, and so it broke down. It's incrementally above that previous high, but you still have. Actually, you know what? You did not have, before I left town, one thing we didn't have was a divergence here on the RSI, which we now do. So let me add that line in down here, go to the very bottom. There's our divergence. We had some PPO divergence, but now the divergence is beginning to steepen on that marginal new high. And you have maybe a little minor uptrend line there that would probably show better on the 60, something like this. Do that, and then we need to crack that. There's your 60-minute divergence. Go to swing trading time frame. And so that one is still a check mark because we broke down there, and this is just a snapback rally. Sometimes you break down below a trend line and you never look back. You zigzag down. Sometimes you break down, you put in, especially when you don't have the divergence already. I like to see that better when you have divergence on both indicators, especially the daily time frame. And so keep in mind, when I'm talking the 60, well, it's near-term swing targets down here, maybe to about this level, 235.50. That would be on the 60-minute time frame, my preferred swing target right there. However, we have big divergence on the daily, and that leads usually to a bigger reversal. And there's a primary downtrend line. So this would mesh with a marginal new high in the Qs. If we go up a little more in Tesla, hit this bear market downtrend line, and then big resistance here at about 316.50. And again, unless Tesla takes out its previous bull market highs, one can argue whether this is a bear market rally or not. Meta. Okay, Meta and Apple are the only two I have as sort of what I call official short trades that give you, price targets and sell signals. This one is yet to trigger any solid break. This is the trend line right here. We're still on. We've been flirting, dancing on that trend line for the last few days since I left town. All I do is extend the divergences. And again, if you look at it here, that's not a solid or impulsive breakdown. And I said this before I left. Anything, the week of 4th of July is probably the worst week other than between New Year, Thanksgiving and Christmas, for trading. Because of that low volume, you tend to get a lot of whipsaws, meaning false breakdowns, false breakouts. So take that with a grain of salt. However, if you want to take it as a purist, then you have a breakdown candle right here on the 29th. That is the day after I left, 2 days. Yeah, I left on the morning of the 28th, I think it was. And so there's a breakdown and a back test so far. Breakdown, back test day 1, back test day 2, back test day 3, and we're back testing right date now, the 5th. Oh wait, well, yeah, 4th day of back testing. So what you want to see, problem with back testing is you can continue to back test and you go higher every day. I like to see a rejection, an impulsive rejection, to show that the back test has failed. And then, I'll give it a check mark because we're below trend and we're back testing, but I'll give it a bigger check mark if and when we take that out and then go on to take the breakdown where we broke down, I should say. We take that out, then that'll increase the odds of T1. And this, I can tell you, there's a very good chance that if this plays out and we go down to any or especially all of my targets, that should take the Qs down with it. So there's your update on the big market leading tech stocks. Semis are still sucking wind. They came pushed out, pretty much tested the breakdown. SOX was based on the 60-minute chart. We broke down right here, and we came down. We hit my first target. Oh no, fell a little shy. I'm sorry, a little shy of my first target. And a little snapback rally. We're back where we were right before I left. So again, really nothing has changed in the technicals since before I left town over a week ago. We're right back to where pretty much we started. And, if you look at the kind of bigger picture, market's not going down in the last few weeks, but it's not going up either. It's just kind of going sideways. And so it's a battle. It's a Mexican standoff, if you want to call it, between bulls and bears. Being that we're back to where we were right before I left, I struggle to see any reason why my outlook would have changed on the market. So it's same outlook, same targets. All right. Sorry, I had to pause the video for phone call. Let me just do this real quick. Give you updates on trade ideas. All right. Start out with Hog is one I'm watching. Hog broke out. I think I shared this with you. I had this alert when I was gone. We had a downtrend line. This is Harley Davidson, a breakout. But what I'm not crazy about, we have some minor resistance there and we're below it now. I want to throw it out to you because we are coming off a divergent low. So if I am wrong on where the market's going, that's my goal here, is to share long trade ideas as well as short trade ideas. And you guys decide what to pick based on your outlook for the market. There's a potential uptrend line. So I think if Hog can power on through here and take out that high, it'll probably head up there to at least this 39.82 level. And if the market really craps out, which I'm still leaning towards, yeah, that breakdown will probably fail. And remember, we're in a bear market. Most stocks are in a bear market. Apple, Nvidia are not the stock market, but unfortunately, on the indexes, they carry a high weighting, so they give it false guise of a more stronger market than it really is. So, I have a lot of stocks still trading, not all 52-week or multi-year lows. A Hog also, that was nice support as well. I'm just sharing random trade. The ones I threw out to you was more official trade ideas. BYND, I want to do an update there. Really close to that trend line. Remember, we hit the minimum on the 60-minute chart, but this is what I've been targeting, the downtrend line, and then we have the 200-day. It just got rejected off the 200-day. That's the blue line right here the other day. So again, it may creep up a little more. This is my, it has been the target zone. If you're in it, just don't let it get away from you. We've gained about 32% since entry so far, maybe a little more. At that initial spike from the breakout, it was up 39%. So, and again, on the 60-minute chart, those are the levels I gave you right here, 1472, and was the first one. That was that initial spike. So, still looking good because it's above the wedge, but it just again got checked on that 200-day, and that we had it checked on the 200-day right there, and that was a level that it took out back here. So there's your update on BYND. I'm kind of think it can make that other thrust. I think we'll go up and make a check of the trend line is my best guess. So again, if you're still in it, maybe just set a stop below these recent lows where it had that first pullback right there. Carvana, CVNA, I told you whether you're in that or not. Ran up here. This was a short, pointed out a short at the 200-day, and that 2466 resistance went a hair above it. But you can see now what we have is a big divergence there on this one, and an uptrend line which we're on right now. This is what I've added. This is an update to the chart. So if you're in it, or you were in it, maybe you stopped out, you considered a new trade idea. If it breaks that trend line, set alert. I think I just added that today, so let me make sure I set an alert to let me know. And then these would be the same pullback targets: T1, T2, T3, T4, T5. So consider that a trade setup or an update if you're still in that one. I gave you HA right before I left on a breakout above 996 or any follow through there. And so far we went up. T1 zone, you have a confluence. I listed the T1 zone as a confluence of the downtrend line, 1136.72. I by the way, just got a price alert on Carvana right now that it broke that trend line I just set the alert on. So 1136, 1172 price resistance, and the 200-day moving averages. So if you took it above that 996 level, I'm just giving a rough number. We hit both the 200-day moving averages. What would it have been yesterday when I was out? And that's for a 12% gain so far. It's getting pretty overbought here. So again, consider it a hit if you took profits. If you didn't take profits and you're holding out for the top of the zone, or potentially, if it breaks out the trend line and all those 200 days, it's probably going a lot higher. I have the next resistance at 1280. So again, there's your update on it. Do with it as you may. Couple others I just got alerts on the last day or two is KFS, but KFS is not below it. Hit the trend line. It triggered my alert. Look at this. It's right on these 200-day moving averages in that uptrend line. And this is Kingsway Financial Services. And that would be a break of that. It's probably taking us all the way down here to 570. That's going to be, if that target is hit, that's a drop of almost 29%. SIGI had an alert on, and that one just broke down. This is Selective Insurance Group. Remember, that's an industry I've been eyeing for a swing or trend short. There's a sell signal I'm going to give you. I don't have targets right now, but just keep it simple. There's one swing target. I think it'll probably have I'll give you a first target somewhere closer to about right there. But I think we can swing it all the way down here to about $75, a little below that. That's going to be about a 20% drop. What else do I have? JP Morgan, I just want to talk on. That's the 800-pound gorilla in the banking sector. I just want to do an update there. You've got this primary uptrend line right there. This divergence, we've been building big divergence on this daily chart of JP Morgan. And so when we break that trend line, I already updated this one before I left town. There's the widest part of the wedge right here. So if it breaks down, that's going to give you a measured target right here down to 119.42. This I can tell you. If JP Morgan hits that target of mine, first of all, it has to trigger the sell signal. But if it does, it's a 15% drop. That's going to take the financials down with it. And that's most likely going to take the stock market down with it. So just like Apple, it hasn't broken down. It's above trend. So it is a potential trade setup, whether you want to take it or factor it in to your market analysis to kind of help with the bigger picture of where the market might go, whether you trade it or not. I keep an eye on that one. What else did I have for you? I threw out Rivian for you on, let's see, right here on June 16th. So that was a little bit before I left for vacation. Rivian will offer an objective long entry on a break above the 1610 resistance level or the 50-day EMA just above that resistance, with an alternative add-on or entry on a solid daily close above. So 1586, it was just, I told you 1610. Somebody asked me why 1610, because at that point in time it was the high of the day. And so I wanted, even though we're slightly above the 1586 resistance, I wanted it to take out 1610 to make sure that wasn't just a whipsaw. That was then, this is now. You got it right there. You went on to take out the level and it didn't get away from you. It was an easy buy above 1610. So if I grab my cursor, I'm on 1613, so close enough. We hit my first target to the button, and there's a quick 30% for you. So again, diversify. Get a lot of nasty comments on QQQ, trying to short the Qs. Spread it out. Take individual stocks, take commodities, take natural gas, wheat. I'll update those in a second, and take these, and 130% gainer, and we've had several of those recently, more than offset a 5% drawdown on QQQ or whatever it is on the most recent. Well, we weren't even down that low on the most recent QQQ. All right, let's jump over to those other two again. Trying to update as many things as I can and not have this video run too long. UNG, somebody asked me, did I still like it? Remember, we hit T2 was hit. T2 was hit right there, so I'm going to mark that. Again, these are actual resistance levels. If you're new to the site, when you see the numbers over here, that's the actual resistance level. I always personally sell a little below, take profits below resistance, because a buyer sometimes will step in a little bit early. So T2 is hit right there, a little pullback, and this still looks constructive. Again, the basis for being long natural gas, you have big positive divergences on the daily chart, just like you had big negative divergences here when we went short. Our sell signal was a break of that trend line, and we had a pretty hefty monster short on that going down. And this is the divergent low. Yes, we've had divergences, and each one played out for a little rally, but the divergence has gotten bigger and bigger. And so right now, if you look at it this way, turn off all the lines, it would help to take out. We already took out that high. We made a marginal new high there. Want to see it go ahead and take out that previous high. T2 is still there. It might have another reaction at 795, but we came close enough. So my guess is if we come at it again, since it was effectively hit, we'll probably pop on up to T3. And again, this is a long-term chart. There's most likely more upside there in that gas. And I'll probably add additional targets. The other one was wheat. Right before I left, I told you on wheat, you can buy down to, but I said I wouldn't buy below T1. I said a back test of the trend line, the primary downtrend line is possible. I'm referring to this trend line right here. And that's what happened. So the gist of it is, this is still bullish to me. There's a breakout, a very impulsive breakout. We hit my second price target. As I said at the time, take profits, and then I turned around and told you, put on as a short right there to do a pullback, and said you can start scaling it at T1, but not down to, unless if you want to back test, fine. So for a longer term investor, you want to buy the back test, great. You can look at it this way. See that little reaction high here? I'm going to tweak my trend line right now. I always say the charts are dynamic, and so is my analysis. So I'll move these trend lines at times. I always try to let you know when I do. So now we come in and we have, the highs there, nice clean reaction there, a breakout right here, and then a back test. So ideally, at this time, if it falls below the trend line, that's no bueno. I can't make a case to buy it then, even with divergence. Ideally, you want to see it start to rally off this back test. And then once it goes on, we already hit T2 once. So if it gets near there again, I expect little to no reaction. It should head up to my third target zone and then fourth target zone. So if you buy it, or if you took profits, which was advised back there, and before I said down to but not below T1. Now that we're comfortably below it, I think you can re-enter with a stop below these recent lows right here. So a very good RR. So look, that's what I mean by a good RR. Risk reward ratio. So if you have a stop, let's say a little bit, not right below the lows, below that trend line, let's just say, what is that, about little bit, maybe 4.5% downside. You can see my pop-up box to the left. It's showing the measuring tool. So around 625, a stop would give you about a 4.5% loss if you took it right now. And if we hit T3, the bottom of T3 zone would be a 22% gain. The top of that zone would be a 27% gain, and a rally up to T4 would be a 32, almost 33% gain. Actually, right on there. Oh, yeah, 32. Okay, so those are your updates. Let's see how the day finishes. Let's see what QQQ does. It's down today, but it's not much. We're only down 1.16. But volatility is starting to expand, and that probably leads me with the last thing I should have updated, Mr. VIX. Told you before, VIX is coming up on some long-term support, and more importantly, we have this big divergence right here. Big positive, aka bullish divergence. The VIX is basically the stock market upside down. You had that minor trend line breakout before I left, back tested, and look, that's that impulsive move. Remember I told you when you're back testing, you can continue to back test. I like to see you start to move away impulsively, and that's exactly what the VIX is doing. So it's got some resistance here, but if it can continue up, and the stock market moves lower, which are one and the same usually, there's a downtrend line that comes into play as a potential target. So anyways, the VIX is looking pretty attractive, especially if these breakdowns in the Qs hold, or we go on to take out the next level. So let me just say it another way, QQQ, and then I'll wrap this up. Break of this level right here, remember that trend line I've been targeting on QQQ, the trend line off the March lows. A solid break of that trend line will likely spike the VIX. It'll probably bring Qs down to the next level, and then these potential targets. And so the way I'll be trading the VIX is, if it hits this target, we'll most likely bounce 321. That's going to be a drop of about 12% in the NASDAQ 100. That will most likely be a many time multiple of that move up in the VIX. And so again, all other things being equal, depending where Apple is, Amazon, Nvidia at the time, if they're all hitting support, and maybe we have some oversold conditions, divergences, I might be covering a QQQ short, selling a VIX long there, taking profits to gain a bounce, again, depending on if we get down there and how things look at the time. All right, let me wrap it up here as QQQ backtests this 361.71 resistance level, thereby providing an objective short entry or add-on. Should it go any higher, you have a gap right here. That would be, the Q's going flat for the day, closing this 1% loss on a gap backfill, where most likely you'd see the sellers step in. This has been Randy Finney with Right Side of the Chart. Have a great day.